Most beginners enter trading with the same belief. If they just find the right strategy, the right indicator, or the right entry signal, they'll finally start making consistent money. They watch YouTube videos, copy indicators, join Telegram groups, and follow so-called expert signals. And for a few days, maybe even a few weeks, things seem to work. But then something happens. One losing trade turns into two turn into five. Emotions kick in. They start revenge trading. They increase position sizes. They ignore their own rules. And before they realize it, their account is down 40, 50, even 70%. The painful truth is this: most traders don't lose because of bad strategies. They lose because of bad psychology. And until you understand how your mind works while trading, no strategy in the world will save you. Trading is not just about charts, indicators, or patterns. Trading is a psychological game. It's a battle between logic and emotion. Every time you enter a trade, fear and greed begin to fight inside your mind. Fear tells you to close the trade too early. Greed tells you to hold too long. Fear tells you not to take the next trade after a loss. Greed tells you to double your position after a win. And if you don't control these emotions, they will control your account. Most beginners think professional traders win because they have secret strategies. But the truth is, professional traders win because they control their psychology. They understand risk, they accept losses, they stay disciplined, and most importantly, they don't let emotions dictate their decisions. Let's talk about why most traders lose money. The first and biggest reason is emotional trading. When beginners start trading, they don't follow a plan. They trade based on feelings. They see a candle moving fast and jump in. They see a sudden drop and panic sell. They see others making money and chase the market. This emotional behavior destroys consistency. Trading should never be emotional. It should be calculated, structured, and disciplined. Another major reason traders lose money is fear of missing out, also known as FOMO. You've probably experienced this before. The market starts moving quickly. You see a big green candle. Social media starts buzzing. Everyone is talking about profits, and suddenly you feel like you're missing out. You enter late, right at the top, and within minutes the market reverses. This happens to beginners again and again. Professional traders don't chase the market. They wait for opportunities. They know that opportunities come every day. Greed is another powerful emotion that destroys traders. Imagine you enter a trade and you're up 2%. Your plan says to close at 2%, but then greed kicks in. You think, what if it goes higher? So you hold. The market reverses. Now you're at break even. You still don't close. Then you're in loss. Eventually, you close in panic. What started as a winning trade turned into a losing one, all because of greed. Revenge trading is another silent account killer. After a loss, many beginners feel frustrated. They want to recover quickly, so they enter another trade without proper analysis. That trade also loses. Now emotions get stronger. They increase position size to recover faster, and within a short time, their account is severely damaged. Professional traders accept losses calmly. They understand that losses are part of the game. Overtrading is another major reason why beginners fail. Beginners think more trades equal more profits, but in reality, more trades usually mean more mistakes. Professional traders often take fewer trades. They wait patiently for high-quality setups. They understand that patience is one of the most powerful trading skills. Lack of discipline is another reason traders lose money. Beginners create rules but don't follow them. They set stop losses but move them. They plan risk management but ignore it. They promise themselves not to trade emotionally but still do it. Discipline separates winners from losers. Without discipline, even the best strategy will fail. Now let's talk about the psychology strategies that beginners should follow to become consistent traders. The first strategy is accepting losses. Many beginners believe they must win every trade. That belief is dangerous. Even the best traders lose trades. Losses are part of the game. Once you accept that losses are normal, your emotional pressure decreases significantly. The second strategy is risk management. Never risk too much on a single trade. Most professional traders risk only 1 to 2% per trade. This keeps emotions under control. When risk is small, losses don't hurt emotionally, and when emotions are calm, decisions become better. The third strategy is having a trading plan. Before entering any trade, you should know your entry, stop loss, and take profit. If you don't plan these in advance, emotions will decide for you. A trading plan removes emotional decision-making. Another important psychology strategy is thinking in probabilities. Trading is not about being right every time. It's about being profitable over time. Even if you win 50% of trades, you can still be profitable with proper risk management. Professional traders focus on long-term results, not individual trades. Another powerful strategy is controlling expectations. Many beginners enter trading expecting quick profits. This creates pressure. When profits don't come quickly, frustration builds. Trading is a skill. It takes time to develop. Lower expectations and focus on learning. Patience is another key psychological skill. The market will always provide opportunities. You don't need to trade every hour. Wait for your setup. Professional traders spend more time waiting than trading. Confidence is also important, but confidence should come from experience, not luck. Beginners sometimes gain confidence after a few lucky wins. Then they increase risk. Eventually, they face losses. Real confidence comes from discipline and consistency. Another important concept is emotional detachment. Professional traders treat trading like a business. They don't celebrate wins too much. They don't panic during losses. They stay neutral. Emotional neutrality leads to better decision-making. Journaling is another powerful psychological strategy. Write down your trades, note your emotions, review your mistakes. This helps you improve faster. Many professional traders maintain trading journals. Let's talk about mindset. A winning trading mindset focuses on process, not profits. Beginners focus on money. Professionals focus on execution. When you focus on execution, profits follow naturally. Another important strategy is avoiding social media noise. Social media can create confusion. Everyone shares different opinions. This leads to emotional decisions. Stick to your plan. Avoid unnecessary noise. Consistency is more important than big wins. Beginners chase big profits. Professionals aim for consistent gains. Small, consistent profits build long-term success. Another psychological trap is overconfidence after wins. After a winning streak, beginners feel invincible. They increase risk. Then losses come. Stay humble. Markets can change anytime. Fear of loss also affects beginners. They close winning trades too early. This reduces profitability. Trust your plan. Let winners run. Professional traders focus on long-term growth. They don't try to double accounts quickly. They aim for steady growth. Another powerful strategy is taking breaks. Trading emotionally when tired or stressed leads to mistakes. Take breaks when needed. Understanding market uncertainty is important. No strategy works every time. Accept uncertainty. Focus on probabilities. Another important concept is discipline over motivation. Motivation fades. Discipline remains. Follow rules even when emotions push otherwise. Professional traders protect capital first. Profit comes second. Beginners chase profits. Professionals avoid losses. Let's talk about the reality. Studies show most traders lose money, but the reason isn't strategy, it's psychology. Once you master your psychology, your performance improves dramatically. Trading success is not about predicting the market, it's about managing yourself, your emotions, your discipline, your patience. If you truly want to become a successful trader, focus on psychology first. Learn risk management, develop discipline, control emotions, follow your plan. Remember this, trading is a marathon, not a sprint. Consistency beats quick profits. Patience beats impulsivity. Discipline beats emotions. Most traders fail because they try to control the market. Successful traders control themselves. If you master your mind, you master trading. And this is where most traders finally understand the truth. Trading success is not about predicting the market, it's about controlling yourself. The market will always move, opportunities will always exist, but your emotions, your discipline, and your patience will determine whether you grow your account or slowly destroy it. Every professional trader you see today went through losses. They experienced fear, greed, frustration, and doubt. The difference is they learned from those emotions instead of letting those emotions control them. They stopped chasing quick profits. They stopped trading impulsively. They built discipline. They focused on consistency. And slowly, over time, they became profitable. If you're a beginner watching this, remember one thing. You don't need to win every trade. You only need to follow your rules consistently. Some days you will lose, some days you will win, but if you stay disciplined,